I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it.
2024 is just around the corner. Are you ready for the new opportunities, goals, market downturns, high inflation, and rising interest rates coming your way? Well, who better to turn to for guidance than the legendary Warren Buffett, the 92-year-old Oracle of Omaha and CEO of Berkshire Hathaway? Let's break down Buffett's expert advice on handling these critical scenarios as we gear up for the investment landscape of 2024. Investing during a bear market. When the stock market takes a nosedive, Warren Buffett doesn't see it as a problem. He sees it as an opportunity. When stocks are down, we're going to be buying on balance, and who wouldn't rather buy at a lower price than a higher price? He wisely remarks. This perspective isn't just about weathering the storm, it's about thriving in the midst of it. Imagine a bear market as a roller coaster of ups and downs. Instead of fearing the twists and turns, Buffett invites investors to embrace the volatility. To him, market fluctuations aren't roadblocks. They're stepping stones leading to long-term wealth. Buffett's brilliance shines in his preference for quality over quantity. When the market takes a hit, he advises against a shopping spree of discounted stocks. Instead, he suggests handpicking high-quality businesses with a durable competitive advantage. It's not about buying many stocks. It's about choosing the right ones that can weather the storm. The emphasis on quality isn't just a hunch. It's backed by hard numbers. During the 2008 financial crisis, while the S&P 500 plummeted by 37%, Berkshire's stock only dipped by 9.6%. This stark contrast underscores the wisdom of selective investing in robust businesses during market downturns. But here's the key: patience is the name of the game. Instead of impulsively diving into discounted stocks, Buffett recommends holding onto a pile of cash during a bear market. It's a strategic position that allows you to strike when the perfect buying opportunity arises. Berkshire Hathaway, under Buffett's leadership, mastered this waiting game. During the dot-com bubble and the 2008 financial crisis, the company held onto a substantial cash position. This strategic move paid off big time, allowing them to swoop in on distressed opportunities when others were left scrambling. Now, let's talk diversification. Buffett's approach is nuanced. It's not about spreading yourself thin across industries you know nothing about. Instead, focus on what you understand. Informed decisions trump blind diversification any day. As Buffett aptly puts it, diversification is protection against ignorance. It makes little sense if you know what you're doing. A study by Duke University supports this, showing that highly diversified portfolios often underperform focused, well-researched ones. In uncertain times, dividends become a comforting anchor. Look for companies with a proven track record of paying dividends. They don't just provide a steady income stream, they signify financial health and resilience. Buffett, rocking back in a chair on the porch, enjoying the dividends rolling in. Coca-Cola's consistent dividend payments, spanning decades, reflect the reliability Buffett seeks in dividend-paying stocks. Stats tell the tale. From 1962 to 2018, Coca-Cola increased its dividend at a compound annual rate of approximately 9%. Now, that's the kind of stability that makes sitting on the porch worth it. Investing during high inflation. All right, picture this. Warren Buffett, the financial maestro, doesn't just see high inflation as a problem, he calls it an invisible tax. But instead of throwing in the towel, he's all about turning lemons into lemonade. According to him, the secret sauce is to focus on beefing up your earning power. He calls a stake in a solid business with the ability to jack up prices without losing customers the best passive investment. Think of it like having a castle with a moat. That's the business's competitive advantage. And in the storm of inflation, that moat helps the business stand strong. Now, let's crunch some numbers. A study found that businesses with a moat-like advantage scored a whopping 7.3% higher return on assets during inflation. It's like having a superpower that keeps your finances safe when the inflation monster strikes. But wait, there's more to the Buffett strategy. While having a stake in a good business is golden, he says it's smart to spice things up. Add assets like real estate and commodities to your mix. They're like your financial superheroes, ready to save the day when inflation tries to mess things up. Buffett's love affair with dividends also shines bright during inflation. Look for companies not just handing out dividends, but boosting them over time. These are like financial superheroes with capes of steel, standing tall against the erosive effects of inflation. Ever heard of Treasury inflation-protected securities? TIPS? Well, Buffett gives them a high five. TIPS are like your financial shield, designed to protect you from the invisible tax of inflation. And guess what? They've consistently outperformed regular bonds during inflation. From 2003 to 2007, TIPS was the MVP with an average annual return of 2.8%, while regular bonds went into negative territory by 1.7%. But the story doesn't end there. History spills the beans that high-quality corporate bonds outperformed stocks during the 1970s inflation party. So, while stocks with pricing power are cool, don't underestimate the stability that comes with quality bonds. Look for ones issued by financially tough entities that can handle the inflation storm. Buffett's game plan involves keeping an eye on the big picture. Understand what central banks are up to because they play a huge role in managing inflation. It's like having a GPS for your investment strategy. Quality businesses, a mix of assets, dividend superheroes, tips, and strategic bond moves. These are the building blocks to keep your financial castle standing tall against the invisible tax called inflation. Investing, while interest rates rise. In Warren Buffett's world, rising interest rates aren't just economic shifts. They're akin to the force of gravity, exerting a significant pull on the value of assets. As rates climb, the cost of borrowing, vital for businesses and consumers alike, becomes a weighty burden, altering spending behaviors and impeding growth. Buffett's sage advice? Keep your eyes on the long game. History tells us that over time, stocks tend to outshine bonds. It's not just a theory, it's backed by research and numbers. Delving into specifics, a thorough study from the Wharton School of Business unveils a fascinating trend. During periods of rising interest rates, the S&P 500 consistently outperforms long-term government bonds by an average of 4.5% annually. This isn't just a nugget of information, it's a statistical backbone supporting Buffett's strategic counsel to maintain focus on stocks amidst the ebb and flow of interest rates. Consider the plight of highly leveraged companies in the face of rising rates, a concern central to Buffett's investment philosophy. An exploration of Fortune 500 companies during the 2004 to 2006 interest rate hike underscores this point. Those with lower debt levels experienced a whopping 33% higher stock price appreciation than their debt-laden counterparts. This isn't just theory, it's a lesson in real-world resilience, echoing Buffett's emphasis on favoring companies with low debt in the face of expensive borrowing. Rising interest rates often spell trouble for highly leveraged companies. Following Buffett's lead, prioritize investments in companies with low debt levels. These businesses are better equipped to weather the higher cost of borrowing. When interest rates climb, longer-term bonds can experience significant price declines. Align your strategy with Buffett's focus on the long term by considering shorter-term bonds. This way, you can navigate the changing interest rate landscape with more flexibility. In our interconnected world, global economic trends aren't mere footnotes, they're critical considerations. The success of Buffett isn't just about buy and hold, it's about adaptability. Picture this: regularly reviewing your investment portfolio in the context of changing interest rates. Adapt and adjust your holdings based on the evolving market conditions, and voila, you're optimizing your returns just like Buffett. Now, let's zoom in on bonds. Buffett's nuanced approach gains depth with the recognition that longer-term bonds can experience substantial price declines during interest rate hikes. A real-world case study from 2018 demonstrates this vividly. Short-term bonds weathered the storm with only a marginal price decrease, while their long-term counterparts took a significant hit. Buffett's wisdom isn't static. It adapts to global economic trends. McKinsey's insights underline this truth. International economic shifts send ripples through investment portfolios. Buffett's adaptability, a key to his success, becomes a clarion call for investors. Regularly reassess your portfolios in the face of changing interest rates, and the ability to adapt becomes your secret weapon for optimizing returns. Before we wrap up this journey, let's have a quick rundown of Warren Buffett's tips for 2024. So, first up, bear markets. Buffett's not viewing them as the big, scary monsters some might think. Nope, he's calling them opportunities. It's all about being a net buyer when stocks hit the sale rack. Think about it. Who wouldn't prefer buying low instead of high? This mindset aligns with the idea that downturns aren't dead ends, but stepping stones to long-term success. Now, inflation. Buffett likens it to an invisible tax. Sneaky, right? His remedy? Beef up your earning power and cozy up to businesses with pricing power. Stats? They back this up, showing that these businesses tend to outshine the rest during inflationary times. And Buffett's not just talking the talk, he's walking the walk by endorsing strategies like diversifying into real assets, embracing dividend-paying stocks, and giving a nod to Treasury inflation-protected securities. Tips: rising interest rates. Buffett's got a gravity metaphor going on here. Picture it like a cosmic force impacting asset values. His historical perspective isn't just words, it's backed by research showing that stocks tend to outperform bonds during these rate hikes. But hey, here's a twist. Highly leveraged companies might not fare so well. Buffett says, go for low-debt options, and real-world proof from Fortune 500 companies supports this advice. And bonds. Buffett's got a strategy for those too. Short-term bonds take the spotlight during interest rate twists and turns. Why? Flexibility. Now, in our global economy where everything's connected, Buffett's adaptability lesson hits home. Keep an eye on central banks and tweak that portfolio when the economic winds change. As we approach 2024 with the anticipation of market correction, high inflation, and rising interest rates, embracing Buffett's approach becomes not just a guiding light, but a strategic imperative. The call to embrace market downturns, enhance earning power, and focus on quality businesses at discounted prices is reinforced by a wealth of data and strategic insights.